Welcome to a new episode of the Opening Bid Unfiltered podcast. I'm Yahoo Finance Executive Editor Brian Sozzi. Like I always say, this podcast that will make you a smarter investor, no doubt about it. And you're going to get smarter on all things crypto. We're just having an interesting year and an interesting time. Joining me now is John D'Agostino, Head of Strategy at Coinbase Institutional. John, good to see you.
Good to see you, Brian. Thanks for having me.
Before we get into the world of Coinbase and crypto, how did you get here? Because you didn't actually start at Coinbase.
No, so I used to be in the rough and tumble commodities world. I was head of strategy for the New York Mercantile Exchange and helped take that exchange from 800 or so guys running around screaming and yelling with crazy hand signals. My first project actually was to help build the trading app to stop using pit cards, because back then they would use literally physical pit cards. And by the way, this isn't like 1920. This is like 2008. Yeah. And they would have these pit cards, and they cost like hundreds of thousands of dollars a year in stationary costs. And my first job ever was to help oversee the coding of an app that would replace the pit cards. And I saw firsthand how angry people get when they see the beginning of their eventual, I wouldn't say replacement, but their eventual need to change. Yeah. And so it's kind of cool seeing it twice. But anyway, did that for a long time, was in the hedge fund world, traded commodities. And then I started teaching at MIT. And about 10 years ago, I wrote a paper on a very seminal moment in crypto history called the DAO hack. And in that paper, I described what I believe to be the pros and cons of blockchain, more pros than cons in my view. And I described myself in that paper as a cynical enthusiast around blockchain. And I got a phone call from a really wonderful guy who was running a big hedge fund called Polychain. And basically they reached out and said, hey, we like this idea. We don't like cynics. We don't want people who have drunk the Kool-Aid. We want cynical enthusiasts. And I learned about crypto from my position at MIT and also from just some of the best investors in the world. That led to a phone call from Coinbase, and the rest is history.
What was it like those early days at the Mercantile, watching people yell and scream? Like, what was that? Not a lot of people have seen that.
Yeah.
And now we're like the older guys in the room. Like,
yeah, absolutely. No, look, I was a poor kid from Brooklyn. I got into Harvard Business School, and it was supposed to be, then it was just like, all right, my life is set. I'm gonna go to Goldman Sachs, I'm gonna do that. And I got this weird offer by an amazing, amazing icon of industry, Vinny Viola. I won a fellowship to go to business school, and he heard me speak and thank the people who gave me the fellowship. And he said, what are you gonna do for a living? I said, I'm gonna go work for a big investment bank. And he said, no, you're gonna work for me. And I remember Dick Grosso. Remember Dick Grosso?
Course, yes.
Dick Grosso was sitting next to him.
OG.
And he looked at me and went, do it, kid. And I showed up at his offices versus the investment bank that Monday and took a shot. And I got to learn about exchanges and the power of price discovery. And I kind of never looked back.
How does that set you up for what you're currently doing?
Well, one thing that keeps me calm, because as crazy as crypto can get, as volatile as the asset can get, it is nothing compared to natural gas options. It is baby time frolics. So
how so?
I have this sort of just literally the vol just doesn't move as much. I mean, I wasn't around Bitcoin in the very early days when it was up and down 90% an hour. But I'm used to idiosyncratic assets, and I'm used to the markets around them, the way they trade. And so the volatility doesn't, I feel very fortunate to learn about trading from the commodities guys, because they taught me at a young age that volatility is not risk. It is a component of risk, but it is not risk. And it's often used as a synonym. Standard deviation or volatility around a mean is used as a synonym for risk. But the reality is, we would all vastly prefer a highly volatile asset that trends upward over time to a low volatility asset that trends downward. And people always say to me, well, how can you feel comfortable having assets like, whether it's, I've heard this for years, commodities, hedge funds, tech stocks, crypto, how can you feel comfortable having that in your retirement portfolio? And my answer is always the same, which is if you can comfortably, with a risk-free rate, satisfy your retirement requirements, absolutely, it'd be insane to do anything else. But if inflation is beating your retirement goals, if the money in your checking account or your stock portfolio is not going to beat inflation or will not meet your retirement goals, the riskiest thing you can do is not put risk assets into that pool. So it just comes down to nothing is promised, nothing is guaranteed. And if we want to achieve these returns, you have to intelligently model out that risk.
I had, at our Invest event here at Yahoo Finance, we had I sat down with Eric Trump, and he gave me he said something to me. I didn't really reflect on it in real time because you're doing the interview. He's like, if you can't stomach the volatility, don't be in crypto. To me, that sounds like good advice.
And you could extend that advice to, I think, any high alpha asset. So yes, no, I don't want to scare away. I'd rather, it is good advice. It's correct. He's 100% right. I try to educate people to the degree I can on finding their own comfort level within a risk asset and distinguishing, again, not to repeat myself, but distinguishing between upside volatility and downside volatility. Also, and this is a fairly recent phenomenon, from an institutional perspective or even a retail perspective, you can actually earn yield on these assets. One of the criticisms about gold and other assets is they're non-yield producing. Yep. Well, now you can actually stake or loan out your Bitcoin or Ethereum or Solana, and you can earn, on a low risk basis, you can earn mid-single digits to high single digits. So you have a great store of value. You have a great technology infrastructure. You have an improving regulatory market environment. And you also have the potential to earn a little bit of an income while you're holding on to that asset. So I think it's the reason why most of the smartest commodities investors I know, most famously Paul Tudor Jones, who had the pleasure of serving on a board for a number of years, when they've stepped back and said, okay, we think inflation, we think debasement and money printing is going to be our biggest problem over the next 10, or a huge problem, 10, 20, 30-year horizon. How do we hedge against that? And the reality is there's no one right answer. Gold is great. It's wonderful. So is other precious metals. So is a basket of commodities. So is maybe a basket of real estate. But none of them are as good as a weighted average portfolio that includes Bitcoin. And they've all discovered that when they've done the math. So that's what I would suggest people think about when they're stomaching this short term. And also, last thing I'll say on this topic of volatility is don't get too excited when things look good either.
Yeah. Nothing goes up in a straight line.
Some things are new, some things aren't. Dollar cost averaging is just a wonderful concept. It's like compounded interest.
You're literally in the trenches with crypto and Bitcoin. Help us understand what exactly is driving the sell-off right now. What is happening?
So as always, I'll hedge by saying two things quickly. One is, as an exchange, we don't make price predictions. We are a price discovery mechanism. Two is, I'm not an asset manager. And to some degree, you should not trust when people who don't have skin in the game tell you. Now, what I can tell you is that I have great insight into what the best asset managers think. So I'm about to tell you is the consensus view from some of the folks who are not just in the trenches like me, but they're in the trenches putting capital at risk. It seems like it's driven by a couple of things. One is just exhaustion. We had a massive run up going into October 10th. Bitcoin hitting all-time highs. Just mathematically, things can't compound at 100% every 6 months ad infinitum. They'll be larger than the.
Sorry, y'all. It's not normal.
It just doesn't work that way. And any asset class, linear interpolation, which is the taking of two data points and extending out a line to infinity, is the killer of every trading firm, or every, I should say, not trading firm. They're smart enough not to do that. But every sort of retail investor that gets hurt generally gets hurt by believing that trend line is going to continue infinitely. It would be larger than the U.S. economy in less than 10 years, if it can, right? So some of it's just like, things have to settle every now and then. Technically, what seems to be going on to some degree is OGs, these large whales. These are people who bought Bitcoin at like 10 cents or $10 or $100, 10 years ago, viewed that 100K and all-time high as a time to start diversifying and selling their. So you're seeing a shift from very, very high net worth retail old holders to institutional. And institutional includes, though, the ETF platforms. So that's one element. A bit of exhaustion, second element. A bit of I wouldn't say letdown, but we had all this incredibly positive news coming out around regulatory clarity. We had the government shutdown, which if you believe that Bitcoin and other cryptos are a hedge against excessive money printing, well, leading into a government shutdown is bad for that thesis because governments don't print money during shutdowns. So now that we have that resolved, we have resolved. Hopefully, we'll see during the next when we understand how much money the U.S. government's going to be printing, we'll see a renewed interest in that trade. So there's no one answer, but I think exhaustion, a bit of a letdown from some really good news leading into October, and OGs diversifying, probably is directionally correct.
Are you a big believer in, I think this was Bernstein put this one out, that we see these sell-offs every 4 years, hence they happen?
So this is every 3 years. So we have a historical four-year cycle, and we've seen down years in 14, 18, 22, followed by meaningful 2 to 3 year up year periods. So there's a bit of consternation in the Bitcoin community because we'll see how the year ends, but this would be a 3 versus 4 year cycle. Man, I've been around long enough in these types of volatile assets to know as soon as you think you have it figured out, you don't. I always pull back to bare principles, basic principles. So why am I sleeping at night fairly well when my 8-year-old isn't coming in and punching me in the face? Nothing's really changed since the all-time high. If we just step back and think about structurally, in fact, you can argue the news coming out about Citibank, JP Morgan, both leveraging stablecoins at a huge scale. The Czechoslovakian National Bank has come out and announced they will be the first Eurozone country to purchase Bitcoin for the Treasury. Clarifying rules from the IRS. Harvard Endowment announcing they own more Bitcoin than gold. All of those things are structurally very, very positive. From the exchange point of view, we're not seeing a massive increase in open interest on our futures market. CME, you can check it yourself. I was always taught early on, a declining price market accompanied by a rapidly declining open interest means the market is breaking down structurally. People are exiting the market forever. When I look at Bitcoin, I see the number of active Bitcoin wallets roughly the same as it was 3 months ago. I see both CME and Coinbase futures open interest, again, ticking down a little bit, but not nearly in line with price direction. And so I go back to the very, very basic principle of if I like apples, I don't like them less because they're on sale. And so if you like this asset, you like it more. If you don't like this asset, if you've never liked this asset, you now have the microphone for a few months or a few weeks, we'll see how long, and enjoy that moment.
All right, hang with us, John. We're gonna go off for a short break. We'll be right back on Opening Bid Unfiltered. All right, welcome back to Opening Bid Unfiltered here at the NASDAQ in Times Square, talking all things crypto with John D'Agostino, head of strategy at Coinbase Institutional. So when there was a lot of retail investors that bought cryptos at the top this year, what should they be doing and thinking as we get into the new year?
Well, I hope that what they bought was not the entire position on a dollar base of what they were planning on spending. So every time I've been asked about this, during bull markets, bear markets, whenever it is, or again, really any idiosyncratic asset, any volatile asset, even one that you expect to go up over time, dollar cost averaging is your friend. I mean, it's just, I've been working in the hedge fund space for 20 years almost. I don't know I've known the best investors in the world. None of them think that they can market time. And if they think that at any period in their career, they get slapped in the face by the market really, really fast. So I genuinely hope these people took that advice. And if they did, if that was an opening position, whatever their intended investment plan was, if that was their opening position, the worst thing you can do at this time is not be consistent and persistent. So I hope if they did go all in and try to market time, I hope they learned a lesson from that and don't do that in the future for Bitcoin or any other asset class. But if they didn't, we know for a fact that not entering the market at the right time, not continuing with that pattern, is what hurts alpha over the long run. That we know with 100% certainty.
What's the catalyst? You ticked off a couple catalysts, and to your point, structurally, things seem the same as they were a couple months ago.
Yep.
What's that next? First of all, what would arrest this sell-off? Like, what would you need to see?
So for me, I need to see changes in the market structure. So what I mean by that literally is a narrowing of depth and breadth of market participant. So markets, we talk about people say, oh, this market's really liquid. That means you can come in and out with little friction. You don't move the price when you come in and out. But that's market depth. How deep is the market? There's also market breadth. How many participants are in the market? And then even more importantly, how many different types of participants? You can't, if everybody wants to sell their bike, I don't care if it's 1 billion people, you don't have a functioning market because everyone wants to sell their bike. If you have a mix of buyers and sellers, that's a good start. But if everybody buying the bike wants it for exactly the same purchase, you don't have good liquidity because maybe you selling your bike, it's not the right color, it's not the right timing, it doesn't have the right speeds or gears on it. So you need breadth of market participation. That means you need institutional players, you need retail, high net worth, average people, you need ETF buyers, you need accredited purchasers, you need strict retail, you need people entering as speculation, you need people who are hedgers, you need all those different types. So that's the one luxury we have at Coinbase is we have to see the breadth of that market because all the market participants come to us. And that encourages me, is I'm seeing more diversity and breadth of market participation than I saw 3, 6, 9, 12 months ago. When that starts to break down, when that starts to narrow, which is correlated to my prior comment about open interest, when open interest decreases, that means people are leaving the market. They're closing a position, they're not opening up a new one. If you close your position and open up a new one, open interest stays level. Okay? If you close your position and go home and say, I'm done with this, it goes down. So as long as the breadth of participation is increasing, as long as open interest is staying stable or increasing, then I'm confident because I believe in the asset. If you don't believe in the asset, you have a different view, but it's hard to say on price direction, but it's hard to say that the market structure is suffering when you have those metrics.
What's the big 2026 catalyst?
So I think Clarity Act being released, I think that's great. I mean, I'm praying for Q4 of this year, maybe Q1 of next year, but I'll leave that to the much smarter policy folks. I think that's probably the big unlock. We have retail participation. The Solana ETF this quarter was the biggest ETF of the year. So I'm comfortable from a demand side. Eventually, supply side will start to diminish. People will hedge out whatever it is they want to hedge out of their position. We saw a ton of the leverage being washed out October 10th. So again, structurally, I'm very, very comfortable.
What, looking out, next year, there's still a lot of interesting characters in this industry.
Yeah.
I just talked to Michael Saylor at our event. He remains all in on Bitcoin. Like, what do you think about some of these? I guess he's an OG, like these cast of characters that still drive that crypto narrative.
So you've got to have evangelicals, right? You have to have people pushing out the relentlessly positive view. And especially if they're as smart as Michael Saylor is, right? I think somebody's listening. I do believe we should listen to the skeptics. I think that's important. Nouriel Roubini is a good friend of mine. We don't agree on this, but I don't want to silence someone as brilliant as he is. I want to hear what they have to say. The good news is I'm not hearing anything from the really smart skeptics I haven't been hearing for 5 to 10 years, so I'm confident that in my position. I think we have to, I think it was my friend Anthony Scaramucci that talked about this in politics, we have to give people an elegant on-ramp. I don't think crypto skepticism is a thing anymore. I think there's crypto resentment. By that I mean is a lot of people who get paid a lot of money to maybe not always be right, but certainly not be colossally wrong. We're colossally wrong about it. And they just were. And I'm not trying to be bitter or anything like that. I'm not trying to gloat. But the reality is if you can go back and if I gave you a time machine, Brian, and said you get to buy only two assets 10 years ago, which 2 assets would you say you'd buy?
NVIDIA and AMD.
Okay, fair enough. Fair enough.
You asked.
But you would agree that Bitcoin would be in the mix.
Yes.
Right? And if you said I would never buy Bitcoin 10 years ago, you're just lying, right? So there's some folks who not just look, you don't have to like every asset class. I have lots of friends who just don't trade what I like to trade, that's fine. But if you've been on the record, just a huge skeptical bear for a decade, that's a little bit embarrassing at this point. So you have 2 choices. You can acknowledge, hey, I probably wasn't right about this, or you can double, triple, and quadruple down. And a lot of folks at a certain stage of their career where they're just better off quadrupling down because they'll just kind of ride it out and retire before they have to really deal with it. So we have to not attack people who had a good faith disagreement with the underlying fundamentals of this asset class. And we have to give them an elegant on-ramp to maybe not become proselytizing evangelicals. Again, not everyone's going to love every asset. It's okay. Not every investor is going to buy every asset. It's okay. But the fact that what effectively is a mathematical formula has become so polarized is odd to me because I don't see people getting into fights at Thanksgiving dinner over the Pythagorean theorem. But for some reason, this notion of a cryptographically protected spot on a ledger inspires, Real Housewife tables being overturned at the holidays.
Lastly, 10 years from now, what role do you see Bitcoin playing in society?
So I see, indulge me 2 quick answers. So one, I'll say Bitcoin and then crypto overall. So I think Bitcoin, I personally see as a predominantly store of value. And I see it as a store of value that is accessible to everyone in the world for any amount of money. So I want 2 things before I leave this mortal coil. I'd love to see individuals who are struggling and saving to get to that next level of economic security. I'd like to see them check their phones, because everyone in the world has a smartphone, and I'd like to see them excited about their economic future because they hold a scarce, immutable asset class, along with other asset classes. And I'd like blockchain and crypto to provide a simple, clean access to US capital markets. So I want to see a world where an individual who has scraped together their first $5 of savings can check their phone every 3 to 6 months and see that their Bitcoin has kept a store of value, and also that using blockchain seamlessly and efficiently, they can invest in the miraculous economic engine that is the US economy through either token sales or tokenized equity sales without paying exorbitant fees, and bet on the US economic engine as well as Bitcoin as the ultimate long-term hedge. The best pension funds I know view dollar cost averaging into the US economy as the best long-term inflation hedge. Add Bitcoin to that, it gets better. So that would be my dream.
Love this chat, and it
Likewise.
comes at such an important time. John D'Agostino, head of strategy at Coinbase Institutional. Don't be a stranger. Let's stay in touch.
I love that.
All right. That's it for the latest episode of Opening Bid Unfiltered here at the NASDAQ in Times Square. We'll talk to you soon.